Today on Real Estate Backstage, the Fed decides to hold interest rates steady, citing an increased risk of stagflation. Howard Hanna has reached a proposed settlement agreement with the plaintiffs of the Gibson case. A lack of transparency at the Federal Housing Finance Agency is raising some questions. And finally, a Redfin investor has filed a lawsuit aiming to prevent the upcoming merger by Rocket. If you're watching this on YouTube or if you're listening on Apple Podcast or Spotify, go ahead and subscribe. That way you don't miss any future episodes of the show. And if you're looking for the show notes with links to all the articles we're going to reference today, you can find that at realestatebackstage.com/episode 28. And if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. So we're going to kick things off today with this article from the Wall Street Journal about the recent Fed press conference. Again, this is according to the Wall Street Journal. Quote, the Federal Reserve warned that tariffs were raising the risk of higher unemployment and higher inflation when officials unanimously agreed to hold interest rates steady on Wednesday. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment, Fed Chair Jerome Powell said at a news conference. Tariffs represent a shock that can decrease an economy's ability to supply goods or services while sending up prices. The unpredictable rollout of increased duties on imported goods threatens to sap profits and chill new investment until businesses have more clarity on their underlying cost structure. The policy changes pose a dilemma for the Fed, which has to decide whether to focus more on the potential for inflation to go up or more on the risk of rising unemployment. Expectations of a rate cut at the Fed's next meeting in mid-June declined on Wednesday. Powell said officials felt like the cost of waiting to learn more about the economy were fairly low. He used the term wait and see 11 times on Wednesday, unquote. So I'm not shocked by this at all. I was actually just having a conversation with one of our agents maybe a week or so ago. Actually, it was on Tuesday of last week, the day before the Fed meeting. And I said, there's no way they're going to raise rates based on the actual data that has come out. The Fed is in wait and see mode. As long as the data remains about the same, we're not going to see any changes in Fed policy. Certainly, there's a lot of concern about what could happen in the near term over the next several months with inflation and economic slowdown based on all the uncertainty and the back and forth policy on the tariffs. But really, the Fed is making their policy decisions based on the actual data that has come out, which is a lagging indicator. We may have all these uncertainties. We may have expectations of what's going to happen in the future, but the Fed is going to sit on the sidelines and they're not going to lower rates until they actually see weakness materialize in the economic data. So if we see the inflation numbers go back up, that could potentially lead them to raise rates. If we see the labor market break, if we see unemployment go up considerably, if we see initial weekly jobless claims go up considerably, if it seems like GDP is continuing to contract. I know we had a really funky Q1 GDP print, but that was really based on a lot of demand pull forward, which you talked about last week, businesses importing a lot more than usual based on the expectation that prices were about to go up. So the economy wasn't really shrinking. That was just businesses stocking up on inventory in anticipation of future inflation. So if we start getting some real negative economic data, like real bad GDP numbers, bad unemployment numbers, higher inflation, those types of things, once we actually start to see the results of the tariff policy work its way through the economy and into the underlying data metrics that are published, that's when we'll see the Fed be a little bit more decisive. But for now, they're just in wait and see mode. So I would expect the next couple meetings, unless there's significant change in the underlying data. And again, it's the backward looking data, the lagging indicators, not the leading indicators, that I think the Fed is just going to sit tight and wait and see what happens. All right, so mortgage applications did rebound last week. You'll remember recently we had 3 straight weeks in a row of a decline in week-over-week purchase mortgage applications. This is according to RIS Media. Quote, a combination of economic and employment news last week that sent mortgage rates back to some of the lower rates that we saw in April led to a bump in home purchase applications this week. According to the latest weekly mortgage application survey from the Mortgage Bankers Association, for the week ending May 2nd, the market composite index increased 11% from the previous week's 4.2% decrease. The economic news last week included a negative reading for first quarter GDP growth and further signs of contraction in the manufacturing sector, mixed with a solid employment report for April, said Mike Fratantoni, MBA's SVP and chief economist. The net impact on mortgage rates was mostly downward, but just back to levels from early April. The 30-year fixed rate declined to 6.84%, unquote. So again, purchase and refinance applications were both up about 11% week over week. That's on a seasonally adjusted basis. And this comes on the heels of 3 consecutive weeks of a decline in mortgage applications, which is kind of unusual for this time of year. We talked about this last week on the show. When you're in late April, early May, that's when the market should be growing. We're in the spring boom of real estate. So we should be seeing an increase in mortgage applications. We saw 3 straight weeks of a decline. So it is encouraging news to see an 11% jump this week in mortgage applications. It is interesting, though, that the increase in mortgage applications was primarily driven by conventional borrowers, not FHA, VA, USDA. So typically we see conventional loans on higher dollar mortgages. That's typically your move-up buyer, not necessarily your first-time home buyer. All right, so let's talk about consumer confidence. This is according to Inman. Quote, the Conference Board reported Tuesday that its Consumer Confidence Index dropped for the 5th consecutive month in April to a level of 86. Now, that's the lowest level since May of 2020, which was the onset of the COVID pandemic. The U.S. trade deficit hit an all-time high in March, and job postings shrank more than forecasters were expecting, with a federal hiring freeze in place and uncertainty over the economy, putting a chill on private sector hiring. The 19-point drop in the Consumer Confidence Index over the past 3 months is just shy of the recession threshold of 20, Moody's Analytics chief economist Mark Zandi posted on X. Unless the trade war cools off very, very soon, recession appears dead ahead. The Conference Board reported that its Expectations Index, which tracks consumers' short-term outlook for income, business, and labor market conditions, fell 12.5 points to 54.4. That's the lowest level since October of 2011, and below a threshold of 80 that's usually a signal of a recession ahead, unquote. So we did just get some news that we've come to an agreement on a preliminary framework for a trade deal with the UK. If we start to see announcement after announcement of trade deal or, initial frameworks, term sheets, not necessarily full-blown trade deals, if we start to see these announcements rolling out on a consistent basis, that is going to really calm a lot of the chaos in the markets. In my opinion, this is really what Trump should have done all along, rather than the whole Liberation Day announcement, which threw the markets into chaos, not just the stock market, but the bond market as well. Rather than doing that, I think, we're the United States. We have the leverage. I think it would have been a much wiser approach to just go to these countries one-on-one behind the scenes and say, hey, this is what we want. These are the terms that we expect. We want to renegotiate our trade deals. Give us X, Y, Z, or we're going to slap you with a big tariff. I think there's certainly a way that we could have improved our trade relationships with a lot of countries, gotten the concessions, the deliverables that Trump really wanted without having to create all this chaos in the market and without having to harm our relationships with a lot of countries that we're allies with, not necessarily geopolitical enemies with. So I think that would have been a wiser approach rather than coming out with these insanely high numbers and then backtracking, pausing, and giving yourself 90 days to strike all these trade deals, which is a very, very short time frame. Very hard to get that done, striking that many trade deals in such a short period of time. Like we've said before on the show, typically it takes years to iron out the details of full-blown trade agreements. So that could have been one approach, or starting with low tariff amounts and set the expectation that they're going to gradually increase over time until a trade deal is reached. Bill Ackman, hedge fund manager, actually proposed this specifically for China. Rather than slapping China with such big tariffs to begin with, starting with a lower tariff, maybe 10%, and setting the expectations that that is going to ratchet up, let's say by 0.5% a month within the first 12 months, and then 1% a month for the next 12 months, and then 1.5% a month for the next 12 months. So over the first year, you get an extra 6%, then an extra 12%, then an extra 18%. Doing something like that, it creates incentive for the other country to actually come to the negotiating table and get a deal ironed out sooner because they know the longer it takes, the higher the tariff rates are going to go. But really what that does is it gives our onshoring capacity more time to be created. It gives American companies more time to figure out an alternative to their supply chain issues. There are a lot of companies right now that import lots and lots of things from China, and all of a sudden their costs overnight just skyrocketed. And it's really hard for these companies to survive, especially small to mid-sized companies. It takes time to redirect supply chain. So if you're currently importing all of your stuff or most of your stuff from China, trying to shift and find an alternate provider in like Vietnam or some other country, it takes time. I think it would have been wiser to start with a lower tariff and have that slowly increase at a graduated scale over time. That way you give companies the ability to plan and adjust and shift their supply chains and survive rather than just slapping them with an insanely high tariff rate overnight. But hey, the president didn't call and get my opinion, so what are you going to do? All right, shifting gears, Howard Hanna has reached a settlement agreement, or a proposed settlement agreement, does still need to be approved by the judge, with the plaintiffs in the Gibson class action commission lawsuit. This is according to RIS Media. Quote, one of the last major holdouts in the commission lawsuits has struck a settlement deal with Pennsylvania-based independent brokerage Howard Hanna, agreeing with plaintiffs to end the litigation according to court filings today. The brokerage had up until now fought aggressively in the largest Burnett copycat lawsuit known as Gibson, even as nearly every other large brokerage firm has struck deals in the seller-filed class action lawsuits, which alleged broad conspiracy and antitrust violations in how agent commissions are structured. Howard Hanna has recently sought to recuse the judge in the case and pushed to transfer it from Missouri to Pennsylvania, largely unsuccessfully. The brokerage is still facing claims from buyers in a separate lawsuit. Representatives from the brokerage declined to comment, and the terms of the settlement were not immediately available, and a judge will still have to approve the deal before any agreement is final. Howard Hanna's decision to settle effectively leaves only one more brokerage defendant in the Gibson case, and that is the Tennessee-based Crylike, unquote. So this has been a long time coming, no surprise here. I think this was really the only outcome that we were eventually going to get to with Howard Hanna, and I would not be surprised to see Crylike settle eventually as well. Now, Crylike has been trying to make the case that they should be covered under the terms of the NAR settlement, but the settlement agreement that NAR reached specifically does exclude them based on how they report their volume cumulatively as a company rather than broken up into several different offices. All right, shifting gears, let's talk about what's going on over at the Federal Housing Finance Agency, the FHFA. This is according to Inman. Quote, the head of Fannie Mae and Freddie Mac's federal regulator, Bill Pulte, says he signed more than 80 orders revamping policies and procedures at the mortgage giants, only a handful of which have been made public. Since being sworn in as director of the FHFA on March 14th, Pulte has issued a raft of orders, decisions, and waivers eliminating programs and practices intended to boost lending in minority communities, protect borrowers from unfair or deceptive practices, and assess risks associated with climate change. The FHFA, which has made no formal announcements of Pulte's orders and has not yet made them available to the public, published 13 orders on its website during Trump's first administration and 11 during the Biden administration. When asked for copies of the additional orders Pulte says he has signed, the FHFA provided the following statement. U.S. federal housing, FHFA is prioritizing efficiencies that eliminate wasteful and unnecessary red tape. We are laser focused on finding smart solutions that make the American dream a reality for Americans everywhere. 10 Democrats, including Chuck Schumer, Cory Booker, and Kirsten Gillibrand, asked FHFA Inspector General Brian Tomney on April 15th to determine if the agency had complied with the law in gutting Fannie and Freddie's boards and to assess whether plans to downsize FHFA would compromise its ability to fulfill its statutorily mandated functions. The next day, Senators Elizabeth Warren, Jack Reed, and Lisa Blunt urged Tomney to open an investigation into FHFA's apparent noncompliance with federal laws and regulations, claiming Pulte is prohibited by law from holding any position at Fannie Mae or Freddie Mac, unquote. So here's my take. Even if the changes that are being made by Bill Pulte over at FHFA are positive and necessary, even if there are great things being done, the lack of transparency is concerning. If there's nothing to hide, just go ahead and publish the order. I don't understand why this is such a big deal. Reporters have asked for orders, and then they provide a statement that really doesn't answer the question, doesn't address whether or not they're going to make them public. Like I said, I don't know what they're doing over there. It looks like they're moving quickly and breaking things. There's probably some good things that they're doing and maybe some things that are being done in a sloppy way. There might even be some things that are being done that aren't quite within the confines of the law, but we don't know because the orders haven't been made public. So I think calling for more transparency, calling for copies of these orders to be made public is a good thing. Now, again, I don't have a position on whether or not Bill Pulte is doing a good job or a bad job. I don't know because we just don't have the information to make that decision. So I think it would be good to go ahead and publish these orders, make them public. Transparency is usually the best policy, especially when it comes to government agencies. Well, meanwhile, we have some potential legal trouble brewing in the upcoming acquisition of Redfin by Rocket. This is according to RIS Media. Quote, the Redfin and Rocket $1.7 billion acquisition, expected to close within the next 2 quarters, just had more drama added to the potential power shift in the portal wars. Redfin investor Bruce Miller is suing the company, along with its board, in New York State Court, alleging that Redfin misled investors by omitting financial details of both companies and the merged businesses. Further, Miller claims that Goldman Sachs who served as an advisor on the deal, failed to disclose its conflict of interest of how much the bank will gain as a result of the deal. According to court filings, Miller seeks to prevent the merger before the June 4th shareholder vote. If the deal gets the green light, Miller will seek rescission or will pursue compensation for damages. He alleges negligence and concealment, claiming that Redfin failed to communicate accurate and truthful information as it closed the deal. On the same day that Miller filed the suit, law firm Halper-Seda, which specializes in aid to defrauded investors, announced its investigation into the sale and whether the 0.7926 shares of Rocket Company's Class A common stock for each share of Redfin common stock is fair to Redfin shareholders. Miller is not represented by Halper-Seda in the lawsuit. The deal, which would represent a significant rebalancing in the jostling between big consumer-facing companies like Zillow, Homes.com, and Realtor.com, was expected to close by Q3 of this year, with a shareholder vote on June 4th. Miller is asking that to be postponed until parties disclose the material information discussed above, which has been omitted. Plaintiff will be irreparably harmed because he will be stripped of his ability to make an informed decision with respect to the Rocket acquisition, and his interest in Redfin will be damaged without proper and fully informed collective action by Redfin's investors, the filing read. Looking backwards, during Q1 2025, Redfin posted $221 million in revenue, a 2% drop compared to Q1 of 2024. Gross profit was $70.6 million, which was flat year over year, while net loss increased year over year from $66.8 million to $92.5 million. Redfin's adjusted EBITDA loss in Q1 2025 was $32 million, compared to $27.6 in Q1 of 2024, unquote. So this is an interesting development. We're definitely going to keep an eye on it, and I'm very intrigued to see what information comes out during the discovery phase, what the attorneys are able to get their hands on, about what information was potentially concealed, not provided to the investors when they were closing this deal. So again, we're going to keep an eye on the case as it develops. All right, we're going to wrap up with another segment of Ask Me Anything. This is where you ask questions and I answer them, hence the name of the segment. Jamie asks, do you have any time management tips that can help me get more organized? I feel like I'm always working, but spinning my wheels and never getting through my to-do list. Time blocking is the number one most important habit that you can build. Schedule the non-negotiables first. Get those things on your calendar, whether it's non-negotiable personal items or work items. Everything else needs to find a way to work around those things. And not everything is equally important. I think this is a myth that's hard to overcome. When you realize that you can say no to things, not everything is equally important. Not everything that's vying for your attention is urgent. Not everything is important. You need to prioritize what is going to make the biggest impact on your business. Those are the non-negotiables that need to be time blocked on your calendar, and then everything else just fills in the space around that. So I would recommend creating a weekly template. One of the mistakes that I see a lot of people make is they try to plan out the perfect day where they have a little bit of everything throughout the day, and then they replicate that over and over and over. And in my opinion, that's just not realistic, not sustainable. Some days might be more heavily tilted towards certain things. You might spend one full day out showing houses. You might spend one full day getting caught up on emails, making phone calls. But rather than trying to have the perfect day over and over and over, I would recommend coming up with a weekly template. Come up with a weekly rhythm that you can try to replicate over and over. And I really do encourage you to use a digital calendar. I know some people, they're just paper calendar, paper planner people. Say that 10 times fast. And that works for them. But what I found is that, at least for me, using a digital calendar is a lot easier because you can just create certain events that are recurring. So for example, every Thursday at 10 a.m., from 10 to 12, you're working on your social media marketing, for example. You put that on your calendar and you say repeat weekly, and it'll do the hard work for you so you don't have to actually flip through all the pages of your planner for the year and block that off. And it also makes it a lot easier to move things around. You've got to be a little flexible. So if you're planning on doing your social media marketing at Thursday at 10, but you have a client who's in from out of town, there's some houses they want to see, it makes it a lot easier to just move that to a different time spot without having to cross through it and erase and change things on a paper calendar. So if you're able to use a digital calendar, that syncs up with your laptop and your phone and, syncs up with your CRM and all that, create recurring events that recur weekly, create a template, and leave a lot of empty space. So you don't need to plan out every minute of every day. I think that's way too difficult, especially if you're a beginner at time blocking. Because if you miss one thing, if you fall a little bit behind, you're going to get discouraged and feel like it doesn't work. So you don't have to look at next week's calendar, or if you were to look at what your schedule looks like 8 weeks from now. Because again, you have a template of recurring events. I could move forward 8 weeks in my calendar and I have certain core things that are already going to be on there. You don't need to create a template that every single minute of every day is filled up. You've got to leave empty space for the things that are just going to organically pop up that you need to handle. So leave plenty of empty space. That way you're not having to completely wreck your plan, reshuffle your whole day just because something changed in your schedule. And here's another thing. A little bit of time being proactive at the beginning of the day means the whole rest of your day can be chaos. A little time being proactive allows you to be in reactive mode the whole rest of the day. Sometimes being a real estate agent, we can feel like we're just in reactive mode all the time. We're responding to requests from other people. A new lead comes in, so you want to jump on it. A client wants to go see a house. An appraisal comes in low. You feel like you have to jump on it immediately. A closing that's supposed to happen this afternoon is having issues, and you've got to get in touch with the attorney or a lender, or negotiate something final that came up during a final walkthrough, right? We're constantly putting out fires. That's part of the job. And if you're not careful, 100% of your time can be spent in reactive mode. And maybe you sell, let's say, 30 homes a year consistently. If you're always in firefighter mode, if you're always in reactive mode, you're probably going to be kind of plateaued and do about the same amount of business year after year after year. If you're currently selling 30 homes a year and you want to get to 40 or 50 or 60, you've got to change your approach a little bit. You can't just always be reacting to what's going on. You've got to be proactive. And it doesn't have to be a giant chunk of your day. If the first hour or two of your day, every day, is spent being proactive on the things that you've identified that will help you make progress and grow your business, as long as you do that first, the whole rest of your day can be chaos, because it doesn't matter if you're in reactive mode, putting out fires the whole rest of the day. At least you know that you did the things that you needed to do in order to drive the ball further down the field and make progress towards your goal. So what does that look like? A lot of people will say, well, I'm not a morning person. I think that's something that a lot of people tell ourselves. And I've gone through seasons of life where it's been difficult to get up early. But what I've found is if there are certain things that you've identified that are of key importance to growing your business, whether that's a lead generation activity, for example, let's say you're going to cold call FSBOs or you're going to send out mailers, whatever you're going to do to generate leads, that's typically the number one thing, right? Lead generation and lead conversion are two of the most important things that you can do to really drive growth in your business. And in my opinion, those activities need to be done first. Now, you don't have to start your day at 5 a.m. You certainly don't need to be cold calling people at 5 a.m. That's a violation of the TCPA. But whenever your workday starts, whether it's at 7 or 8 or 9 or 10, whenever your workday starts, you really need to knock out those non-negotiables first. So tell yourself, I'm not allowed to do anything else until I've made at least 20 phone calls, for example. Just an example. Or until I've written X number of handwritten notes, or until I've knocked on X number of doors, or until I've recorded X number of videos that I'm batching for social media content, if that's your thing. Whatever those important things are that you know are going to be critical to driving growth in your business, knock them out first. Because if you plan on doing that, let's say at 2 in the afternoon or at 5, 6 o'clock in the evening, you might have every good intention. It might even be on your calendar, but the odds are something is going to come up that's going to derail your plans. So it's better to knock those things out first. That way you minimize the risk of something going wrong and you not getting to those items. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes, the links to all of the articles we referenced at realestatebackstage.com/episode 28. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.